Today, we're digging into Elastic, ticker ESTC, and their first quarter earnings report for fiscal 2026. And boy, is this an interesting one. We've got a classic Wall Street head-scratcher on our hands.
So here's the deal. On one hand, you've got this earnings report that just absolutely crushes it. The stock explodes, up over 20% in after-hours trading. But then, what happens? The next day, it's a complete reversal. All those gains? Gone. The stock actually closes down more than 3%. So what on earth happened here? Let's dive in and figure this out.
All right, first things first. Let's just look at the raw results because, on the surface, this was a quarter that should have had investors popping the champagne.
Okay, the beat on the bottom line, it was just massive. We're talking non-GAAP earnings per share of 60 cents. Now keep in mind, Wall Street was only looking for 42 cents. That's a 43% beat. I mean, that's not just good, that's a signal of some seriously impressive profitability and execution.
And the top line, just as strong. Revenue clocks in at over $415 million, smashing the consensus estimate by more than $18 million. Again, this wasn't just squeaking by. This was a loud and clear signal that demand for their platform is really, really strong. And this chart, it really tells the story of where that strength is coming from. You see, total revenue grew a really solid 20% year over year. But here's the kicker. Look at Elastic Cloud revenue. That's up 24%. Now that's the number you want to watch. It's the company's strategic future, right? And it's their fastest growing segment. It just goes to show that their whole cloud transition and serverless stuff is really catching on. And if that wasn't enough, the business is just an absolute cash-generating machine. I mean, they pulled in $116 million in adjusted free cash flow in just one quarter. For a company growing at 20%, having a 28% free cash flow margin is just incredibly strong. So you look at all these great numbers, and you have to wonder, what was management's side of the story? Well, behind these fantastic numbers, management was painting an incredibly bullish picture. They're basically positioning Elastic as a key winner in this whole generative AI explosion. So on the earnings call, they were just rattling off all this positive momentum. Their Search AI platform seeing huge demand. They've got over 2,200 cloud customers using it for Gen AI stuff already. They've launched some really key new products like their Elastic AI SOC Engine. They call it EASE, which is for security. And they're making big moves in the public sector with a new GSA deal. But maybe the most important part, they're taking market share. A full third of their new security deals were actually them kicking out a competitor. That's huge. And the CEO, Ash Cole-Karney, he kind of summed it all up perfectly. He said, and I'm quoting here, "The company is positioned to be the leading data retriever and context engineering platform for the AI era." So what does that even mean? Well, think of it this way. They provide that crucial, super relevant data that all these big language models need to actually be accurate and useful. They see themselves as the bedrock, the foundation for enterprise AI. Okay, so we've got a killer quarter. We've got a super confident AI-powered story from the execs. Which brings us right back to our puzzle. It all boils down to the guidance. What in the world did the market see that it hated so much? Right? With all this good news, what could possibly be the problem? And here it is. This is the smoking gun. Just look at the numbers. In Q1, the quarter they just reported, revenue was $415.3 million. Okay. Now look at the guidance for Q2, the next quarter, a range of $415 to $417 million. At the midpoint, it's basically flat, no growth, zero. And for a software company like this, one that trades at a premium because everyone expects high growth, seeing flat quarter-over-quarter revenue is a massive red flag. It just screams that momentum is hitting a wall. So even though management actually raised their forecast for the full year, the market just completely panicked about this near-term slowdown. And that fear just totally wiped out the memory of that amazing Q1 beat. All right, so let's put it all together and give our verdict. How do we square this? How do we balance the incredible execution and all this AI hype with the market's very real fears about slowing growth? Here's our call. First, on next quarter's results, we expect them to hit that flat guidance. The things you're going to want to watch are continued AI customer adoption and any big security wins, because that's what could set them up for growth to pick up again later. Second, the stock price. We see it being stuck in a range for a little while. The market is basically in a show-me mode right now. It needs proof that growth is reaccelerating, or it needs a big catalyst, something like getting that FedRAMP High certification, which is a huge security clearance for big U.S. government deals. So putting it all together, our rating is market perform. The company's doing a fantastic job, but the stock seems pretty fairly valued until we get more clarity on that growth picture. And as always, just a final reminder, this analysis is for informational purposes only. It is not financial advice.